Something shifted on New Year's Day 2026 that most Americans completely missed. While you were nursing hangovers or making resolutions you'd break by mid-January, China quietly activated a major upgrade to their digital currency infrastructure. Sounds technical, boring, nothing to worry about, right? Wrong. What happened on January 1st represents a fundamental change in how global finance could work, and it directly threatens the mechanism America has relied on for decades to fund its massive spending. Let me be crystal clear about something right up front. This isn't some doomsday prediction where you need to sell everything tomorrow morning and buy gold bars to bury in your backyard. That's not what we do here at Next Generation Finance. What this is, though, is a slow-moving tectonic shift that's already changing the foundation of the international monetary system. And if you don't understand what's happening, you can't position yourself appropriately for what's coming. Here's the number everyone talks about: $38.4 trillion. That's America's official national debt as of early January 2026. It's growing by over $8 billion every single day. That's not a typo. $8 billion daily. 334 million per hour, 5.5 million per minute. But here's what nobody's explaining clearly: that 38 trillion is just money we already borrowed. It doesn't include what we've promised to pay. Medicare has unfunded obligations exceeding 52 trillion over the next 75 years. Social Security adds tens of trillions more. Federal employee benefits, veteran commitments, another 15 trillion. When you calculate the complete picture, including all those promises to future generations, researchers estimate America's total fiscal gap reaches somewhere between 160 trillion and over 300 trillion depending on methodology and time horizons. Let that sink in. Not 38 trillion, potentially 300 trillion in total obligations when you account for everything we've committed to paying but haven't funded. Now, America doesn't technically have a debt problem in the traditional sense. We can print dollars. We'll never default in the literal way Argentina or Greece did. What America has is a financing problem, a mathematics problem. We need other countries to keep lending us money by buying treasury bonds. And for 75 years, they didn't really have a choice. If you wanted to buy oil from Saudi Arabia, you needed dollars. If you wanted to trade internationally, you cleared through American banks. If you wanted to participate in the global economy at scale, holding U.S. Treasury bonds wasn't optional, it was necessary. That forced demand created an incredible advantage. America could borrow enormous amounts at artificially low interest rates because everyone needed dollars for commerce. It was the ultimate captive market. But on January 1st, 2026, that captive market started becoming optional. China's upgraded digital Yuan framework represents something fundamentally different from previous attempts to create dollar alternatives. It's not trying to replace the dollar everywhere. It's creating parallel infrastructure where countries can transact without touching dollar-based systems when that's more efficient. And it's working at scale far faster than most analysts predicted. Project M-Bridge, the cross-border payment platform built around China's digital currency, has now processed over $55 billion in transaction volume. That's a 2,500-fold increase since early 2022 pilots. The platform has handled more than 4,000 actual cross-border transactions involving China, Hong Kong, Thailand, United Arab Emirates, and Saudi Arabia. They're trading directly in their own currencies. No dollar conversion required. No American banking infrastructure involved. Think carefully about what that actually means in practice. When Thailand imports electronics from China, historically they had to convert Thai baht to dollars, send those dollars through correspondent banks in New York, then China would convert dollars to yuan. Every step generated demand for treasury bonds. Every transaction reinforced dollar dominance. Now, they settle instantly on M-Bridge. Direct currency exchange, lower fees, faster settlement, no dollar exposure needed. One transaction doesn't matter. 10 transactions don't matter. But 55 billion in volume? That's when network effects start compounding. That's when the mathematics of financing America's debt begins shifting in dangerous ways. Let me walk you through exactly how this creates problems. It's not sudden. It's not dramatic. It's methodical and relentless. Start with interest payments. Over the past 12 months, America paid $981 billion just in interest on the national debt. 5 years ago in October 2020, that number was $345 billion. It nearly tripled. Why? Because the average interest rate on marketable debt went from 1.55% 5 years ago to 3.36% today. Each 1% increase in rates costs an additional $380 billion annually in interest. Here's the trap. America now pays more in annual interest than we spend on Medicare, which keeps elderly citizens healthy, more than we spend on national defense, which protects the country. Interest has become the second largest budget item after Social Security. Not programs that benefit Americans, payments to bondholders. And a substantial portion of those bondholders are foreign governments and institutions. But it gets worse. America doesn't just pay interest on existing debt. We constantly roll over maturing bonds. Every week, billions in Treasury securities mature. The Treasury Department must sell new bonds to pay off the old ones. It's like using one credit card to pay another credit card's bill. This only works if buyers keep showing up at auctions willing to purchase the new bonds. For decades, this was automatic. Foreign central banks needed dollars for international trade, so they bought treasuries as a place to park reserves. It was mechanical, predictable, guaranteed demand. But look at what's happened. Japan now holds about $1.1 trillion, roughly 3% of total U.S. debt. China holds $756 billion, about 2%. Those numbers have been declining steadily, not because these countries suddenly hate America, because they need fewer dollar reserves when they can settle trade directly in digital currencies. Every country using M-Bridge for transactions needs marginally smaller dollar reserves. Smaller reserves mean less treasury buying. Less buying means America must find new purchasers, offer higher interest rates to attract them, or have the Federal Reserve print money to buy government bonds directly. All three options make the underlying problem significantly worse over time. Here's what most people miss entirely. China's digital yuan doesn't need to become the world's reserve currency to change everything. It just needs to make dollar usage optional rather than mandatory for certain transactions. By the end of November 2025, China had processed 3.48 billion cumulative transactions worth 16.7 trillion yuan, approximately 2.4 trillion US dollars. That volume grew 800% in just 2 years. More importantly, China adopted a strategy combining interest-bearing features with stablecoin-like functionality while keeping the digital yuan completely sovereign and regulated. Starting this year, commercial banks will pay interest on digital yuan holdings. This makes it genuinely attractive for businesses and consumers, not just as a payment method, but as a store of value. China is testing this across border regions and tourism economies, including Hong Kong, Macau, Laos, Thailand, Cambodia, and Singapore. Each connection creates another pathway for commerce that bypasses American infrastructure entirely. Imagine you're running an import business in Thailand. You buy goods from Chinese suppliers regularly. Traditionally, every transaction required currency conversion to dollars, fees at multiple points, settlement delays, and exchange rate risk twice, once converting to dollars and again converting out. Now you can settle directly in digital yuan through M-Bridge. Instant, cheaper, no dollar needed at all. You don't abandon dollars for everything. But for that specific trade relationship, you just bypass the dollar system completely. Multiply that scenario by millions of companies across dozens of countries, and the daily demand for dollars drops. Not catastrophically, not overnight, but consistently, relentlessly, compounds over time. That's the erosion. Not replacement, reduction. Now here's where this becomes genuinely dangerous. Markets don't price risk in straight lines. They price it exponentially through confidence mechanisms. Right now, U.S. Treasury bonds are considered the safest asset globally, the risk-free rate, the foundation for all financial modeling. But what happens when markets start questioning whether America can actually service this debt long-term? Not outright default. America will never technically default because we control the printing press. But what about the real purchasing power of those dollars? What about the value of bonds when they eventually mature? When confidence starts eroding, and it always begins small at the margins, interest rates rise not because of Federal Reserve policy changes, but because investors demand higher risk premiums. The 30-year Treasury note currently yields 4.83%. That's higher than recent months. Why? Because markets are beginning to price in fiscal uncertainty. Here's the feedback loop that creates the crisis. Higher interest rates make debt more expensive to service. More expensive debt means larger budget deficits. Larger deficits require additional borrowing. More borrowing means increased bond supply hitting markets. Greater supply with questionable demand means even higher interest rates to attract buyers. This is how confidence evaporates. Once the cycle starts, it's extremely difficult to stop without dramatic fiscal reform. And America can't even pass basic budgets on time, let alone implement generational structural changes to spending and taxation. The Congressional Budget Office projects net interest as a share of total government outlays will be 13.85% in fiscal 2026, 14.11% in 2027, and 14.52% in 2028. If those percentages start accelerating faster than forecast, that's your critical warning signal. Let me be absolutely clear about causation here. China's digital yuan isn't creating America's debt problem. America created that problem entirely through decades of spending more than we collect in revenue. But the digital yuan is accelerating the timeline by removing one of America's biggest structural advantages, the captive market for dollars and treasury bonds created by forced usage in international commerce. In 2025, China pursued aggressive international expansion of digital yuan functionality. Saudi Arabia's central bank joined mBridge in 2024. Think about the implications. Saudi Arabia, America's oldest Middle Eastern ally, joining a Chinese-led payment platform. They're not doing this to harm us. They're doing it because it's objectively superior technology for certain use cases. Project mBridge tackles major inefficiencies in cross-border payments, including high costs, slow settlement, and operational complexity. But the side effect is enormous. Every country using mBridge extensively needs fewer dollars in reserve. When countries hold smaller dollar reserves, they buy fewer treasury bonds. When fewer bonds get purchased at auctions, interest rates must rise to attract buyers. And when rates rise with $38 trillion in existing debt, you see how the mathematics breaks down. Smart analysts are calling this a slow-motion crisis precisely because it happens so gradually that most people won't notice until positioning defensively becomes too late. Here's a critical framework to understand. America can handle $38 trillion in debt at 2% average interest rates. That's $760 billion annually, manageable within a $6 to $7 trillion budget. But America cannot sustainably handle $38 trillion at 5% rates. That's $1.9 trillion in annual interest, exceeding defense and Medicare spending combined. And America absolutely cannot handle $160 trillion plus in total liabilities if financing costs rise across the board for all government obligations. Right now, the debt grows by $8.03 billion daily, $334 million hourly, $5.57 million per minute. The question isn't whether this trajectory is sustainable. Obviously, it's not by any mathematical measure. The question is, how long can this continue before markets force a reckoning? That's where the digital yuan matters fundamentally. Every transaction settling on mBridge instead of through dollar systems represents marginally less treasury demand. Not enough to matter today, but compounding relentlessly month after month. The digital yuan now comprises over 95% of mBridge's total settlement volume. The platform is increasingly used for trade in energy and commodities, the two sectors historically generating the most dollar demand globally. If those transactions start settling in digital yuan at meaningful scale, the mathematics changes very rapidly. Energy transactions alone represent trillions annually. Shifting even 10% of that volume away from dollars would significantly reduce treasury demand. Now, I know what you're thinking. This sounds like fear-mongering. The dollar has supposedly been collapsing for 50 years according to various predictions. Yet, here we are. China's economy has its own severe problems with property sector issues and demographic decline. All true. But none of that changes the mathematics around America's financing needs. Here's why you shouldn't panic, but should definitely pay attention. First, markets don't price systemic shifts overnight. The transition from British pound to US dollar as reserve currency took decades. Dollar dominance won't evaporate in a month or year. These are slow-moving tectonic shifts measured over extended periods. Second, there's no clear, complete alternative yet. The euro has structural problems with fiscal integration. The yuan isn't fully convertible internationally. Gold can't scale for global commerce. Bitcoin remains too volatile for institutional settlement. The dollar remains the best available option in a world of imperfect choices. But best available is fundamentally different from no alternatives exist. That distinction matters enormously. Third, timing macro events is nearly impossible. You could be completely right about direction, but wrong about timeline, and lose everything in the meantime through opportunity cost. The market can stay irrational longer than you can stay solvent, as the saying goes. So what do you actually do with this information? Understand, this is a transition, not a sudden collapse. The dollar system isn't ending next month. But the era of absolute unchallenged dollar dominance is clearly shifting. That transition will likely take years, possibly decades, but it has real consequences requiring appropriate positioning. Watch interest rate situations extremely closely. If the Congressional Budget Office's projections for interest as a share of spending start accelerating faster than forecast, that's your key warning signal. Pay attention to Treasury auction results. When the government sells bonds, monitor the bid-to-cover ratio and yields required. If Treasury starts having difficulty selling bonds at reasonable rates, that's when slow erosion accelerates into something more urgent. Diversify appropriately, but don't abandon the system entirely. You still need significant dollar exposure. You still need some Treasury holdings for liquidity and safety. But having exclusively dollar-denominated assets in a world where dollar dominance is systematically eroding carries increasing risk that didn't exist previously. Focus on real assets and productive capacity. In eras of currency uncertainty, assets generating actual cash flow tend to preserve value better than pure financial instruments. Businesses with pricing power, real estate in desirable locations, productive infrastructure, things creating value regardless of which currency dominates international trade. Most importantly, stay invested, but stay informed. The problem with these transition narratives is they make people think there will be some dramatic moment visible on news channels. But that's not how these shifts actually unfold. Revenue falls short of obligations gradually. Financing costs rise slowly, then suddenly. Confidence erodes at margins until it cascades all at once. Mathematics breaks down in slow motion until the day it doesn't. Right now, we're in early stages of a fundamental transformation in global finance mechanics. The digital Yuan is one piece, but it's the piece making other changes possible. China is encouraging adoption by integrating digital currency into WeChat Pay and Alipay. That's 1.4 billion people becoming comfortable with digital currency in daily life. When those same individuals and their businesses start using it for cross-border commerce to save money, network effects kick in powerfully. More usage drives more infrastructure development. More infrastructure enables more adoption. More adoption means less dollar dependency. And every 1% reduction in dollar dependency translates to marginally less treasury demand, which means marginally higher interest rates, which means marginally higher debt servicing costs. Compound that over a decade, and 38 trillion becomes 50 trillion at higher rates with fewer willing buyers. That's when mathematics stops working. Every decade, someone predicts dollar collapse. Every decade, they've been wrong so far. I understand the skepticism completely. But here's what's genuinely new. For the first time in modern history, there's credible alternative infrastructure for international settlement that doesn't require dollars. Not just theoretically. Actually built, actually functioning, actually processing billions in real transactions currently. The technology exists and works at scale. The network grows month by month. Incentives align perfectly for participating countries, and America's debt mathematics deteriorates every single month. Those four factors haven't existed simultaneously before. Empires don't collapse when debt becomes too large. They collapse when debt becomes inconvenient to finance. For 75 years, lending to America through Treasury purchases was convenient, automatic, necessary for participating in global commerce. That convenience is eroding currently. Not gone, eroding. The digital yuan isn't making it impossible to lend to America. It's making it increasingly optional in ways that didn't exist previously. And when lending to the world's most indebted nation becomes optional rather than obligatory, the price of that lending increases substantially. Mathematics becomes harder. Sustainability becomes questionable. You don't need to sell everything today. But you need to understand the ground underneath the financial system is shifting in ways that haven't happened during our lifetimes. Certainties governing investing for 50 years are becoming uncertainties requiring adjustment. Watch interest costs month by month. Watch treasury auctions. Watch digital currency adoption spreading across international trade. The transition isn't coming in some future dramatic moment. It's already here, already happening. It just moves slowly enough that most people won't recognize it until looking back in 5 years, wondering when everything changed. The answer? It changed on January 1st, 2026, when China made their digital yuan a true functioning alternative to dollar-based systems at meaningful scale. Everything after that is mathematics playing out to its eventual conclusion. Nothing breaks tomorrow, but the mathematics already broke. The question is just how long before that becomes obvious to everyone instead of just those paying close attention. This is not financial advice. Always do your own research and consult with qualified professionals before making investment decisions. If you found this analysis eye-opening and want to stay ahead of macro shifts that most people won't understand until it's too late, subscribe to this channel right now and hit that notification bell. These aren't topics mainstream financial media covers honestly because the implications are too uncomfortable. Drop a comment and let me know, are you adjusting your strategy based on these international monetary system changes, or do you think dollar dominance is secure for decades to come? I want to hear your perspective on where this is all heading.